I want you to learn from my investing mistakes. I've had some big wins with investing from 2020 to early 2021. I doubled my money in 1 year in the stock market, which previously I didn't even think was possible. But I did that, and I wasn't buying options either. But I made a lot of mistakes as well. So I wanted to sit down in front of the big sycamore tree, which reminds me of, given enough time, how large things can grow. I'll give you a little peek there. It's really hard to see the whole thing, but it just keeps going and going. Of course, it's lost most of its leaves right now. Moving on, first investing mistake that I made was putting too much in stocks and not enough into ETFs. ETFs, of course, are exchange traded funds. They're sort of the next iteration of index funds. And the reason why I count this as a mistake is that there is more risk in stocks. So you've got to do your research and your math and your analysis to invest in stocks without having that risk and making potentially some big mistakes, because anything can happen. You know, it can be a change in leadership. It can be something that the CEO tweets and all of a sudden your stocks are 10% down. There can just be a lot of things that you have a bad quarter, something impacts the trajectory of that stock. Whereas ETFs are going to include many stocks, maybe dozens, maybe hundreds. Of course, the best known is the S&P 500 index, and you can buy ETFs that cover the S&P 500. Now I use a different model for designing my portfolio. You may be familiar with the core satellite model, because I want to have that diversification that I can get from ETFs. And I still invest in some individual stocks, but I give them a smaller piece of my portfolio. Mistake number 2, I didn't maintain enough savings while I was investing. I chatted via email with a gal who was interested in my investing boot camp, my Double Your Money boot camp. And as we went back and forth, I realized that she really didn't have savings yet. And I suggested that this wasn't actually the right step for her, because if you don't have an emergency fund, then if you're putting money into investments that rise and fall and you have an emergency come up, you need a new car, there's a medical emergency, and you might be forced to sell stocks when they're down. Maybe if you're in a retirement account, you might be paying penalties and taxes and other costs. And you don't want to be in that situation. We want to keep our savings and our investments separately. And I had separate savings, but as I gained more and more confidence around my investing, I started moving over a little more and a little more and a little more from my savings into my investing, until the point where my savings really was compromised and I didn't have enough when I needed it. I'll tell you one of those reasons why here in a moment. Mistake number 3, taxation was an afterthought. Now, we don't want the tax tail wagging the whole dog. And I've heard people say, heard a financial professional say, well, all these people who thought they made all this money in 2020, gains of 50% or more, oh, they're going to be sorry at tax time. No, I don't think we should ever be sorry when we are paying taxes on gains, on profits that we earned. However, we could be more proactive in our investments in the ways that it impacts our taxes. One way is that I just started investing in a brokerage account. A lot of people do that without stopping to think, what are the containers that I could be investing in, and is this the right container for me? The 3 basic containers are going to be a taxable brokerage account, a traditional IRA, or a Roth IRA. We have the choices of those. The taxation is different on all of them. Furthermore, I learned that, all stocks, or all things that appeared to be stocks, weren't taxed the same. REITs or partnerships, there's different kinds of things that you can buy in your brokerage account. But when it comes to taxes, sometimes you have to fill out different forms. It's more complicated. The tax rates might be different. So that was a really great experience. Like, wow, did I make this complicated for myself? And how can I simplify? It's not that maybe I won't buy those things in the future, and I have some of them, but I purchased them perhaps within a Roth IRA, so I don't have that complication at tax time anymore. Mistake number 4, I was chasing momentum instead of balance, stability, diversifying, etc. And chasing momentum, I would say a mistake, but also a strength of mine. I'm amazing at noticing trends, at recognizing patterns, and that was one of the things that allowed me to gain so much in a short amount of time. But I was also like, ignoring the fundamentals. People are riding these stocks because it's like a wave. It's going faster and going higher, and we're going to ride that wave. But at some point, if the fundamentals aren't substantiating it at all, then you're going to see a crash. A great example of this was I was heavily invested in alternative energy. And a lot of those alternative energy companies really did not have the fundamentals. I knew that I was riding a momentum wave, and maybe there's nothing wrong with that if you understand the dangers, but I had, I would say, too much of my portfolio, and I could have lessened those positions, eliminated maybe a couple of them. I could have been more cautious about it as well. So right now we see that there are some trends. We see that the dollar is weakening. We see that the money printer is printing. We see that even though the economy is struggling for various reasons, AI is replacing some jobs while making some companies more profitable. So we see these trends. Right now we see that QT has ended, which is quantitative tightening, which means we are preparing ourselves very likely for a season of quantitative easing. The money printers are going to turn back on. So there are ways to invest to capitalize on those trends. There are also very, very long-term trends. Of course, the long-term trend is seeing the dollar weaken, seeing gold has been on a multi-year trend of gaining while the purchasing power of the dollar shrinks, which is one reason why we've got to be investing. So mistake number 5 would be, oh, this is embarrassing. Like, oh, I am going to confess this because, I want you to learn from my mistakes. And I had, people that I would consider mentors say, don't do margin, but I did some margin. I felt like I was doing it very conservatively. I used some margin on the way up and got hit on the way down with a few, maybe 3 margin calls, something I never want to have happen again. So margin, by the way, is using leverage. It is taking the stocks that you have and borrowing against them. Oftentimes you can do that right in your brokerage account. Leverage is great if you're gaining. It's not so fun if you're losing. And I learned that even though I felt like I was being really conservative, that when stocks headed down, that the brokerage could instantly change its mind about what was a reasonable, amount of margin for somebody to have. So when you get a margin call, it's ugly. It's just like the brokerage is like, hi, I know the stocks are really down today. And by the way, you have to sell some right now. And if you don't pick stocks to sell, we'll pick it for you. So that was a mistake. And I really understood, why, oh, ouch. Yeah, margin can be dangerous. The way that some of the larger Wall Street companies use it is way worse. I was using a little bit of margin, but they will use massive amounts of leverage. It's why actually that leverage explains why sometimes when things start heading down, we see this like, oh, and down more and down more. We see these days where sometimes it feels like things are just getting out of hand, where the selling doesn't even make sense because you see high quality assets sometimes being sold because they've got to sell something. When you get a margin call, you've got to sell something. Mistake number 6, I made investing way too complicated and time consuming. I spent a year just consumed with learning how to invest, getting up really early. I'm on the West Coast, so it's early when the stock market opens. I don't regret it at all. I was literally spending hours every day learning and researching and being in the market and buying and selling and just seeing how things reacted. It was learning that I couldn't have gotten just from a book or from watching a course, like actually doing the investing and actually looking in my portfolio and noticing like, why are my dividend stocks acting very differently from my tech stocks today? Why people talk about the stock market like it's one thing, like the S&P 500. That's typically what people mean, but different portions, different segments of the stock market can be behaving very differently, and it can be a fun game to play. I love it when the S&P 500 is down and my portfolio is up. I feel like I've won some sort of a little prize. And even this year, my returns have been really great, even though I have simplified so much. I've got year to date, my brokerage account is over 30%, my IRA is over 20%. And I'm not spending hours a day. Some days I spend zero time. Like I forget about it. I'm busy. I don't check in. Other days it might be 5 minutes. Some days I might watch a video or do a little bit of research because I'm interested in it, and not necessarily even something that makes me buy or sell anything in my portfolio. But I do enjoy tracking the trends. And at the end of 2020, maybe beginning of 2021, I taught my first investing class, and I remember thinking, I noticed that not everybody likes to spend insane amount of time in their portfolio. Most people really want it simpler. I want it simpler too. I finally woke up to that fact that I'd rather be spending time, helping other people invest, doing other things with my life as well, rather than way too much screen time. So it's important to really figure out what kind of investor are you. I did lots of swing trading in 2020, which basically means I wasn't really a day trader where you're getting in and out in one particular day. That wasn't my thing, but I did a lot of swing trading, which was holding stocks or funds for perhaps weeks, maybe months, or several days at a time, but not holding them long term. And now I've just simplified. I am much more long term about what I'm doing, even while I'm sometimes following some trends. So let's see. 7, my last mistake is that everybody says this. Biggest investing mistake is not starting sooner. I sat out the 2008, 2009 stock market crash. I could have been investing, but my mind, that just wasn't where my brain was. It wasn't in the stock market. I was very involved in real estate investing at the time. Also started caregiving my father during the not so great recession, as I like to call it. And really, it didn't even cross my mind until a couple of years later about the idea of investing. Oh, I could invest in the stock market. And I think I actually did have an IRA at the time, but I wasn't. It was like somebody had sold me a mutual fund, but it wasn't investing for myself, which is a whole different level. So I did a reel recently, or a YouTube short that would be on here, showing the difference between investing for 15 years versus 25 years. I'm already 62. So I might invest for the next 25 years. I enjoy investing. I remember Charlie Munger saying in one of his last speeches, he and Warren Buffett, that their investing secret was, we stayed invested and we didn't die. And I researched I call them the secret millionaires, the working class folks like Ronald Read, who was I think he was a J.C. Penney's janitor who built up a fortune of $8 million through his investments. And he stayed invested into his 90s. And you look at the other secret millionaires, who are the working class folks who have built up these multi-million fortunes. They've become philanthropists, and all of them, they lived long, they stayed invested. So I consider this a skill that I will always keep learning and honing, and something that I love to teach, which is why I am launching the Double Your Money Boot Camp. You may have seen me talk about it, but we are starting on December 11th. It'll be on Thursday evenings. There's also recordings. We're just having 2 meetings before we break for holidays. And if you're watching this later and you're like, oh, I missed it, get a hold of me, because I am willing to do a catch-up session first week of January to get folks up to speed. And then we'll meet January, February, and you will be confidently invested. And I will share some of my secrets and what I see and the trends. And I love beating the S&P 500. I'll also show you, you might be like, that's nice, Kate, but I prefer something a little more boring. And I will show you how you can add stability, you know, compared to the S&P 500. We can add some income, we can add some stability, and you'll be given some tools where you can evaluate what kind of investor are you. You might not be the, I see the waves coming, there's a storm, I'm gonna learn how to surf. You might be, let's steady the boat, and we'll look at also the big picture of investments, because I would never recommend that you have everything in the stock market, particularly if you are over 60 like I am. But it's not too late to start, even if you are. Join me for the Double Your Money Bootcamp. You'll find information in the description. And I hope you enjoyed this video and my embarrassing confessions.